Hello everyone. This week we'll learn about stock compensation. Stock compensation is a very common practice in the corporate world in the United States and all over the world. Employees and top executives, especially CEOs, CFOs, COOs, they receive a huge amount of equity related incentives or different type of stock compensations. The major objective of giving this stock compensation is to align the interest of the shareholders and the interest of the managers or employees. There is a classic theory in the business and economics literature, which is known as the principal and agent theory, where shareholders are known as the principal and managers and employees and top executives are known as the agent. So the objective of our effective compensation plan is to align the agent's interest with the principal interest, which means that to motivate the managers in such a way that they can do their best to maximize the shareholders' interest. And that is why stock compensation is very popular and widely used for aligning the employees and shareholders' interest. There are several types of stock compensation plans. One of the most important plan you will see that widely practiced is stock options. Stock option does not mean that an employee is receiving the stocks or shares. Rather, employees are receiving the right to purchase the common stocks at a given price after certain years of their service. So the objective of including stock options in addition to the basic cash salary and other performance bonuses are again to motivate the employees and to make the compensation program very effective and efficient. And research shows that if we provide stock options and other stock related compensations, it is more likely to retain the executives for a longer period. And employees also receive some tax benefits, and employees work their best to do the best performance and for operating returns and profits that will also impact on the stock price, and ultimately the increasing stock price, the benefits will also be enjoyed by the employees who are receiving the stock options and other type of stock related incentives. Now, if you look back before 1990s or 80s, you will see especially the top executives such as CEOs, CFOs, they are not used to getting like huge amount of compensations because they mostly used to receive cash salaries and performance bonus. And later in late 80s and early 90s, these different type of equity related incentives were tied to compensation plans, and all together, in addition to cash salary and other bonuses and the different type of equity related incentives or compensation plans, now top executives and especially CEOs are receiving huge amount of compensation. So here you will see the recent trend, what happened in last decades. These are the median compensation for S&P 500 CEOs. They are receiving millions of dollars, and if you look at that, the majority portion of these compensations are coming from stock related or equity related compensations. Now, if you look back here in this trend, you will see that the stock compensation is huge and it could be up to 40% of the total revenue of a company. And if you even look at these stock compensations, you will see the total amount is huge, hundreds and thousands million dollars that top executives and CEOs are receiving. And especially if you look the company, different type of companies and technology-based companies, where companies may not have huge amount of cash and to give high cash salaries, it's very common practice to give the employees and CEOs and top executives these stock related incentives. Now we will first discuss about the stock options and later few other types of stock compensation plans. Now, here, as an employee, if you receive stock options from your employer, what you need to look at? First, remember the company is not giving you stocks or common shares. Rather, the company is giving you an option or the right to purchase the stocks at a specified price. And you are not obligated to exercise or use the options. You can exercise it or you cannot. And there will be a specific price at which you can purchase the shares, but you just cannot exercise the stock options right after receiving it. You need to serve or work for the company for a certain period. So when you receive the stock options from your employers, you have to look at when you can exercise it. So the period that you cannot exercise it is known as the service period or vested period. Then once the vested period or service period is gone, then you have the right to exercise the stock options. What you will do, you will look at the stock price. So if you see that the stock price is higher than your stock options price, then definitely you can exercise it. For example, here you will see in this slide, your stock options exercise price was specified as $20 per share, and after 3-year service period, now you can exercise your options and purchase your company's shares at $20, and you found that the current stock price in the market is $30. So yes, it completely now makes sense to exercise the options. You can purchase the shares at $20 and you can sell at $30 in the market, and this is how you can make some gains by exercising your stock options. Now if you see market price of the share went down and it's below 20, then it would not make any sense for you to exercise the stock options. Now several other points you have to remember if you receive stock options. For example, can you transfer your options? No, you cannot sell or you cannot transfer your options to anyone else. And will your options expire? Yes, every options when it is granted, you will see that it specifically mentions several things. For example, what should be your service period or the vesting period. Second, what will be the your option exercise price. Third, it will also mention the expiration date. That means you will receive a certain years to exercise your stock options. Now when we start the accounting part of the stock options, you have to figure out few other things. One is the determination of the expense of stock options. You saw some examples, some high-tech company or the companies that do not have huge amount of cash to pay their employees, they easily can use these stock options or few other stock related compensations. But they should also record it as an expense, compensation expense. Otherwise, in another sense, they will undermine or understate their expenses. So whenever a company gives stock options to their employees, they have to determine the stock option expense based on the fair value, and they will determine the stock options expense or the fair value of those options based on different criteria. Black-Scholes model is a very common model which is widely used, and that will be determined on the grant date. That means when they give the options to the employees, remember they cannot exercise it right away. They should have to hold it for the service years. And during the service period, what the company will do? The company will allocate or spread out the stock option expense or the value of the options. So now we will see one example and you will get a better idea. Dunder Mifflin Company on November 1st granted the top 5 executives some stock options, and the options here is to purchase 2,000 shares, $1 PR par value, which is the fair value. And here the company grants the options on January 1st, 2025, and the executives may exercise the option any time within the next 10 years after 2-year service period. And the option price was $60. The market price at the date of the grant is $70. Now, what they also did on the grant date and under the fair value method using the Black-Scholes option pricing model, they calculated that all those 2,000 shares stock option price are based on Black-Scholes model. The value is $220,000. That means this should be the compensation expense for all those stock options on the grant date, $220,000. So what the company will do? So we will see how the company will record this or the journal entries. Here on the grant day, the company just determine the compensation expense or value of the options. That's it. But they don't record anything. What they will record? They will allocate the compensation expense over the service periods or years, and they will record it at the end of each service years. So if you remember from the previous slides, the total compensation expense based on the fair value Black-Scholes model, the price or the value of those options, that was $220,000, and they have 2-year service period, so they will allocate it. That means if we split $220,000, every year's compensation expense should be $110,000. So at the end of each service period, the company will debit compensation expense $110,000, and the company will credit it as an equity paid in capital, but it's not pure common stock. They're not issuing stocks. Rather, they will label it as stock options. Again, the next year, that means at the end of the 2nd year service period, they will record the same journal entry, compensation expense debit and paid in capital stock options credit. This is how they are allocating the stock option compensation expense over the 2 years of the service period. Now assume that the service period is over and the executives can exercise the options. So if Dunbar's executives, they exercise 20% of the options, this is 3 years and 5 months after the date of grant, what the journal entry the company will record. So the employees exercised 20% of the options. So what they will do, they will eliminate these 20% stock options, which is currently in their capital or equity. They will eliminate that, and since the employees are exercising it, they are receiving stocks, they will issue those as common stocks, and employees are giving cash and getting the stocks. In once they are purchasing the shares, the company is receiving cash. So this is the journal entry that the company will record when the executives are exercising the stock options. So look at the numbers. First, 20% of the total stock options that they granted. So 220,000, which we initially showed as an expense over the 2 years period, and this 220,000 was in our paid in capital, so I'm eliminating 20%. And then we are issuing 2,000 shares, and 2,000 shares, $1 par value, so common stock will be credit 2,000, and the rest we will record as additional paid in capital. Now if you remember from the beginning of the example, the option exercise price was $60. That means the employees had the right to purchase the shares for $60. So they are recording $59 as additional paid in capital, or paid in capital in excess of par common stock. And the company is receiving cash after issuing 2,000 shares at $60 price. This is how the company will record if the executives exercise the stock options. Now, what if the executives will not exercise the stock options? If the stock market, they see that the stock price in the market actually is lower than the option exercise price, definitely they will not exercise it. Or maybe it's up to them. Even the stock price is higher than the option exercise price, they may choose not to exercise. So if employees do not exercise the options, and what the company should record after the option expiration period. So we will see here, once the option expiration period is over, the company needs to remove or reclassify the equity portion that they are still showing as stock options, and they will just rename it as expired stock options. So in this example, we assume the rest, or the 80% of the stock options, were never exercised. That 80% was still in our paid in capital, labeled as stock options, so we will eliminate those. That means we'll debit those, and then we'll keep it in our equity paid in capital, but we'll now label it more properly as expired stock options. This is how the company will record it if stock options are not exercised. So this illustration will give you some idea. First is the grant date, when the company grants the stock options to their employees. On that day, based on the fair value and some option pricing models, the company will calculate the fair values of those options, which they will determine or consider as the compensation expense, and they will allocate or show that entire amount is splitting over the service period years, and they will show it as compensation expense. And once the options are exercised, then they will reclassify those as stock options to show as stock issuance. Now here what will happen, if stock market price is actually higher than the option exercise price, employees will exercise it. If not, employees may not exercise, and after the expiration date, the company will also remove those stock options from paid in capital and reclassify as those expired stock options in their equity.